At first, inflation does not always feel dramatic. Prices rise slowly, coffee costs a little more, groceries become more expensive, and rent increases over time. Because it happens gradually, many people do not notice the full effect right away. But inflation quietly changes the value of money. It does not need to take money out of your account directly. It simply reduces what that money can buy. This is called purchasing power. If you have $100 today, the real question is not only how much money you have, the real question is what that money can still buy. If prices rise while your money stays still, your money becomes weaker in real terms. That is why inflation matters so much for savings. Saving money is important because it gives security and flexibility. But if money sits still for many years while prices keep rising, its real value slowly shrinks. This is the silent erosion of wealth. Imagine someone saves $10,000 and keeps it untouched for years. On paper, they still have $10,000. But if prices have increased, that same money may buy much less than before. That is the difference between nominal value and real value. Nominal value is the number you see. Real value is what that number can actually do. In finance, real value matters more. This is why inflation changes the way people think about wealth. It raises an important question. Is my money only being stored, or is it being protected and growing? Cash still has a purpose. Emergency savings matter. Liquidity matters. But cash alone is not always enough to preserve wealth over the long term. That is why people often look toward assets. Businesses, real estate, stocks, and productive investments may grow with demand, produce income, or adjust over time. They are not perfect, and they carry risk, but they can sometimes protect purchasing power better than money sitting still. The key idea is simple. Inflation quietly weakens passive money and rewards productive money. One person stores money without growth. Another person owns assets that may rise, produce income, or adjust with the economy. At first, the difference may look small, but as inflation continues, the gap becomes clearer. Wealth is not only about having more money, it is about keeping the value of that money alive. So when we talk about inflation, we are not only talking about rising prices. We are talking about the changing strength of money itself. And once you understand that, you begin to see why financial education matters so much. Because if inflation slowly reduces purchasing power, then not understanding money can become very expensive over time. That is exactly what we will explore next.